I'll make a quick announcement too, to make sure everybody is on mute. Since Bob's the host, it'll be difficult to mute the lines if they come on. So if you can make sure you mute. And Steve, if you're on, I'll have you run through the announcements. I think you have those.
Yeah, can you hear me okay?
We gotcha.
Okay, so all right, so first announcement is that we do have the live meetup in the left field in Columbus, Ohio on October 20th through the 21st. Registration is still open, so there's only a few open spots left, guys. So if you are on the fence, I would recommend that you go ahead and try to get involved, get registered if you can. The October 24 meeting is canceled due to our in-person meetup, which is going to be a few days before that. So also we do have a deal webinar coming up with passiveinvesting.com. It is a Class A apartment in Myrtle Beach, South Carolina, and that will be on Thursday, September 29th at noon Eastern time. And we have a lunch and learn on Tuesday, October 4th at 2 p.m. Eastern time. It's called the Recession Resistant Asset Classes with Logan Freeman from FTW Investments. And we do have a new website feature. It's we have a calendar on our website. If you go under meetings and there's upcoming meetings underneath that tab, you can click on on that and you'll see the actual calendar, which will show all the mound visits as well as the announcements that I just made. And also make sure if you listen to our podcast, I hope you listen to our podcast, that you give us a 5-star review. It will help us to get more high-profile guests. And I'll go ahead and introduce our speaker today. It's Bob Frazier, who is a co-founder and CFO of Aspen Funds, a fund management company focused on alternative investments. Aspen Funds is one of LFI's preferred partners. Bob has extensive experience as a finance and technology executive and is a former Entrepreneur of the Year award winner. He is also the co-host of the Invest Like a Billionaire podcast. Bob's topic today will be economic megatrends, why investors need to pay attention. Also, Bob, I believe you're going to be talking about a new partnership deal with TribeVest for any tribes that are formed to invest in Aspen Funds. So I don't want to steal your thunder. So if you want to talk about that in your presentation, please feel free to do that. But I'll let you take it away, Bob. Thank you very much for taking your time to present to our group.
Sure, my pleasure. Nice to meet you all. And so I know some of you are longtime investors in Aspen. So thank you very much. And we're just very blessed to serve you and do our best there. So I'm going to share my screen here. There we go. Hopefully you all can see that. I'm going to share some kind of fun megatrends, stuff that you have not seen and not aware of. And we're gonna have a blast. So it's great having this kind of format. So I'll be able to take some questions, and we have some time. We'll do that. So looking forward to meeting you all in person at the event, because we're going to be there too. All right. So I was already introduced. I'm a former computer scientist from UC Berkeley. I apologize for that, but no, I am. And actually was a technology executive. I started a tech company in 1990s. It blew up. It became a big deal. I raised $44 million in venture capital, and it blew up. And as he said, I won the Ernst & Young Entrepreneur of the Year award. We became the fastest growing business in the Midwest region of the United States in the late 90s. And so it was quite a ride. At Aspen, this is not a one-man show. We have a team of senior executives with tons of experience. Jim Mafuccio is my partner, 30 years real estate experience, as well as an oil and gas engineer by training. Also, Dan Schulte. Dan was actually senior general counsel for Waddell & Reed, which is a $1 trillion money manager in the Midwest, and was a general counsel for them. He's a attorney, as well as a Big Five accounting guy and tax specialist. And then Ben Fraser, our managing director, is a banker and underwrote 150 deals as a banker. And we love that, just that banking experience and bringing kind of world-class underwriting. That's our senior team at Aspen. One of the things that many of you know us for is our income fund. We're super proud of this. It's been going on over 8 years. It's audited. We have about 1,100 mortgage notes in this fund. We buy them at a huge discount. We maintain very high safety factors, very low ITVs. And one of my favorite statistics is since 2017, we've had 42 defaults, and we actually, in our defaulted loans, we actually have made a 54% profit on those loans. So because we buy at a discount, so it's soared through COVID. It's just a wonderful, wonderful fund. We absolutely love this fund. We take care of it. It's our baby. Over $60 million invested, and 9% yields. And with liquidity, one of the fun things about this is because it's mortgage notes, they're basically paid off all the time. We have every month we get people pay off their mortgage notes when they sell their home or refinance, and so we offer liquidity to our investors. So we're very proud of that, and just keeps growing. About me, this is my world. These are my 8 granddaughters. Yes, it is possible to have 8 granddaughters. I proved it's possible, even though it is extremely unlikely. It can happen. So my world is this, and that's my beautiful wife of 38 years. And so that's my life, little visit of my life. Now I'm going to dive in. And I shared a little bit about my history with the tech fund. I want to share what I learned in 2001. Some of you maybe weren't investing in 2001. Well, in 2001 was the great .com crash. So I had a .com. It was in 1995. We were the fastest growing company in the Midwest region of the United States in the late 90s. So this thing was a rocket ship. And then it just blew up, 300 employees, and then it blew up. And I lost everything in that. And so I, at that point, became passionate about understanding what is going on in the markets, understanding the tides. And here's a picture of the tide out and the tide in. And so in 1999, right, it doesn't matter how bad your .com was, right? Didn't matter. It was going up. If you had, trash.com, it was worth, hundreds of millions of dollars. And in 2001, it didn't matter how great your .com was, it went down. So Amazon, you could have bought Amazon for 30 cents per share in 2001. It dropped to 95% of its value. And so I figured out, one, the markets are insane. They're stupid. And so number one is follow the tides. When the tide comes in, like 1999, all boats float. It doesn't matter how bad your .com is, it's going up, right? And in 2001, when the tides are going out, it doesn't matter how great your boat is, it's going down. And so I became passionate about understanding the tides. And that's what this presentation is about. I'm going to show you the tides, at least a couple of them, that I'm interested in, that I'm following in, that are economic tides that we can profit from. So I became passionate about understanding the tides, figuring out what's happening. And the other lesson is go private, that the public markets are primarily insane. They're primarily manic. And, the fact that you can, the trash.com would be worth, $1 billion and Amazon.com worth 30 cents. Both extremes are just insane. And so I became passionate about understanding the private markets, and that's why I started Aspen, is to understand the private markets. And here's just a for instance. I just looked these up today. These are REITs. Anybody in the public markets, you know what a REIT is? It's a real estate investment trust. And you think, so most investors, I think, they want to buy real estate, so they go look up a REIT. And in fact, a REIT is really more like a real estate sausage. than it is real estate. If you want real estate, buy real estate. Here's just some examples today. This is today. So I'll pick Prologis. This is an industrial company. They have a 22 PE, and a PE is basically the number of years to get your investment back, 22 years to earn your investment back. And here's the price to book, 2.33. That's the price you're paying for the share versus the real estate value of that share. And in other words, so if you're putting in $100,000 in Prologis, you're actually buying $43,000 in real estate and $57,000 in fluff. I mean, it's, who knows what it is, right? It's nothing. It's you know, where's the beef? So that's literally what that means. The price per book is how much you're paying for the book value of the real estate carried at a current market value. It's nuts. And so that same company, by the way, Prologis, in 2011 was selling at 50 cents in book value. It means for every, if you invested $100,000, you were buying $200,000 worth of real estate at current market values for that real estate. Now that's the time to buy in the public markets, because the public markets go insane periodically. So I figured out that the public markets are primarily sentiment and narrative driven. Whatever the narrative is, they go manic and they go depressive. And I wanted something that was steady, that was just right on. So the lesson here is, if you want to buy real estate, then buy real estate, don't buy sausage. And so we became passionate about going private, where you can get much better deals. I mean, for example, a deal we did earlier this year, our Aspen retail investment, we just bought a bunch of neighborhood centers. Your price per book is $1. And if you invest $1, you get $1 worth of real estate equity. And the PE was 4, means it takes you 4 years to earn your money back on that deal. You know, and it doesn't matter what, there's no sentiment about this. And yeah, it's not liquid. So that's the price you pay for that, you know, but much better investments. So at Aspen, you know, here's our process is we first identify the macro trends in play. First thing is we figure out what is actually going to go up and what's going down. What are the tides doing? What tides are coming in and what tides are going out? And then we identify the best asset classes and strategies that are going to benefit from those tides. So we figure out what are the strategies to play. Then we find the best investments and the best sponsors to invest in. So we're very, 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 very different than other firms. We're not, a lot of companies in our space are in real estate, and it's you know, I know a lot of guys right now that are trying to buy multifamily, even though they need to be careful in buying multifamily. And it's like this. It's like when you have a hammer, everything looks like a nail, right? And that's the problem. We don't have any hammers at Aspen. We are primarily looking at what is happening in the markets and what's the best way to win. The other thing here, you know, our team co-invests in every deal. We primarily started this strategy as a way to place our own capital. We are primarily investors, and we simply bring our tribe along too. So it is, we absolutely do due diligence and underwriting of everyone for our own capital and every deal. So we're not salesmen. We're not salesmen. We're primarily investors, and we allow others to co-invest with us. So pretty big difference. All right. And then as they mentioned, we started this podcast a year ago. Invest like a billionaire. Doesn't mean you have to be a billionaire, but you can invest like one. And billionaires have 50% of their wealth invested in alternatives and in private alternatives. So we've had a lot of fun with this, and it's already top 10% of all podcasts, and so we have a blast with it. All right, with that, I'm going to jump in to our megatrends. I'm just going to hit a few megatrends that are your friends. Okay, megatrends that are your friends. Here we go. Number one friend you may not know is inflation, and we may have seen the worst, but not the last of inflation. So I'll talk about that in a minute. But I've been talking about this for several years now. I personally believe that we will see the supply chain issues are easing and will ease, but the energy and worker shortages will continue. And so if you look at this chart here, this chart over here, consumer price index, if you look at the largest components, what is the largest component here? Energy is the primary driver of the consumer price index changes. And primarily energy is going to continue in its high price. And I'll talk about that in a minute here. And then here's the wages, of course, which have spiked up now. So the supply chain issues are coming down, and energy and wages are going to stay high. Now, if there's a recession, you'll see the wages start to soften, the wage gains soften, and you'll see energy prices soften. So we'll see this coming down. So my view is I don't think we're going to see much higher than this range we're having right now, the 8 to 9% range, but we're not going to see 2% inflation. We're probably going to equalize somewhere in the 4 or 5 or 6% inflation range for the next several years, and primarily because of energy. Good news is that we're not in recession yet. Now the Fed can create a recession if they want to create a recession. I was doubting their resolve earlier on, but I don't doubt Powell's resolve anymore. And we're not in a recession. If you look at this, is the GDP in Q1 on the left and the GDP in Q2 on the right, and a lot of positive. The biggest negative here was net exports in Q1. Net exports is not a big problem. It was primarily COVID driven. And if you look in the Q2, the other is change in private inventories as people are building inventory back after post-COVID. So neither of these big negative draws on GDP components were sustainable. And so I've been saying that I think recession is going to be very difficult to achieve because of the health of the consumer, but I'm not going to get into that in this presentation. We have a very healthy consumer right now because of stimulus, because of job gains, and because of housing price increases, the wealth effect. We're seeing a very healthy consumer right now. And, again, that can all be, the Fed keeps how far they go. They can definitely eliminate some of that, but it's going to be very difficult to put our economy in recession. But it's also possible. So talking about inflation is a wealth destroyer and a wealth creator. You choose. It is your best way to get rich and your best way to lose money. You choose. So I just did a little math. So here, this is I call it inflation magic at 8% inflation. So we're running, above 8. But let's say we have 8% inflation for 10 years. Okay, so these are years down here. So this is 10 years in the middle of this graph and 20 years out here. In 10 years, the value of a dollar. So if you have $100,000 in your bank account, it'll buy $46,000 worth of goods in today's value. In other words, so the value of a dollar of savings is eaten away every year. So light a match, start a bonfire on your savings account, okay? It's 46%. On the other side, if you have a piece of real estate and it keeps pace with inflation, it's doubled 215% of its value. The cost of stuff goes up. It doubles in just 10 years at just 8% inflation. So guess what? This is if you are saving money in owning cash, this thing is destroying your wealth. Inflation destroys your wealth. On the other hand, if you have negative cash, yes, I said negative cash. Well, how do you have negative cash? You owe money. You owe money. If you are a borrower, well, your principal balance is on fire, and light a match and start a bonfire with it. It is burning up. So debt is one of the key ways to make money, as long as you have fixed rate debt and good debt, and your costs are below the rate of inflation, your cost of that debt. So one of the best ways to do is to borrow money. And by the way, one of the best ways to make money is inflation protected real estate. So real estate is actually a great way to make money. By the way, who's the largest debtor in the world? The United States government, which is what they figured out. A little inflation actually does massive damage to the national debt. Massive. And this is what they figured out, which is why in all the history of the United States, in spite of World War II debts and other times we've had over 100% debt to GDP ratio, the US has never defaulted on its debt. You don't need to default. You just need a little bit of inflation to wipe out the debt. So inflation is actually a massive transfer of wealth from savers to borrowers. And so you just need to make sure you're a borrower. And again, with smart debt, and that means debt that you can afford to pay no matter what, and debt that's below the rate of inflation, fixed rate debt. So inflation is your friend, and it's a way to make a ton of money. And in spite of interest rates going up, I want to point this out here. Nominal rates are rising. Nominal rates are headline rates, right? Interest rates. You see, the Fed is raising the rates, whatever 3% they are now. So this little red line on the chart here, this is interest rates. But you see inflation is still way above interest rates, aren't they? What that means is that real interest rates, the real cost of money, is strongly negative. And in fact, interest rates have to go up a lot more, or inflation has to come down a lot more before real interest rates, meaning inflation adjusted interest rates, are positive. So when interest rates are negative, when real rates are negative, hard assets go up in value. So this is the time to own hard assets, and that means real estate, amongst others. There are many classes of hard assets, but this is absolutely a time to be owning hard assets. Real rates are negative and likely to stay so for some time now. Now Powell, he's pushing both ends of this. So, some point he'll win, but for right now it's negative. Again, real interest rates are highly correlated to cap rates for you real estate investors. So, when negative interest rates, as I've said, negative real rates are going to be a boost to all things real estate and keep cap rates low. So it's a good time to be doing all classes of real estate. We're loving a lot of different kinds of real estate. We're staying away from, and I'll tell you my last megatrend. I want to tell you our favorite investment in real estate, maybe one you're not aware of, and why we think that's the winner of winners and the winner take all in today's race. Not super excited about hospitality real estate or office real estate, but we're excited about several other asset classes. All right, that's megatrend number one. All right, here's number two, is energy prices. And my subtitle for this is "A False Narrative Produces 7 years of Underinvestment." And so we're now paying the price for a really, really bad narrative that took hold. It's really false is what it was. And here's the narrative. So what happened in 2014, this new narrative kind of became dominant. And if you've been paying any attention, you've read about this. And this idea that fossil fuels had reached peak demand, that fossil fuels, that their day was over, that green energy was going to be the future. And simultaneously, there was this initiative called ESG, the Environmental, Social, and Governance Initiative. They focused on reducing fossil fuel consumption. Great. But they also focused on reducing fossil fuel supply. Let's stop drilling. Let's stop investing in fossil fuels. Uh-oh. Okay, well, you better hope you're not reducing supply before you're reducing demand. But that's exactly what happened. And so what happened with these two things, what happened is long-term investments in fossil fuel projects declined down 55% since 2014. This is from the Wall Street Journal, this graph on the right. So what happens globally, this is not the United States, global energy investment dropped by over half. And this is really devastating to the energy infrastructure, because energy is different than every other asset class. If you don't spend millions of dollars in your asset, it depletes in production. So you lose production every year unless you're doing a massive investment. And as a result, today's global energy supply is severely constrained with no prospect of rapid increases. So huge energy crisis we're in the middle of it right now. And, so for the last 2 years, production has not kept pace with post-COVID demand. This is from the Energy Information Administration. You can see the little circled area here is inventory changes. So what's happening is production has not been able to keep up with consumption. The result is that global oil inventories are at record lows. And now this was all before the Russian invasion of Ukraine. So this is also from Goldman Sachs. And you see global oil inventories peaked in April of 2020 and are just going nowhere. Goldman Sachs says basically oil inventories are at record lows and will take an oil price above $140 to rebuild. They say supply remains inelastic to higher prices. What that means is that higher prices will not result in increased oil supply. Why? Because there's no more to be had. You can't drill another hole in a big enough to make a big enough impact in enough time. One of the third quotes that jumped out at me: the negative global growth impulse remains insufficient to rebalance inventories at current prices. I love Goldman Sachs speak. Here's what that means: is that the recession that is trying to be created is not enough to change inventories at current prices. So basically, recession will not significantly change this. And their final quote that jumped out said, the market will not build sufficient spare capacity by the end of 2023, extending the bull market into 2024 plus. So we have a brewing energy crisis. Good thing we have President Biden, who has figured out how to fix this, and he's dumping our strategic petroleum reserve, which was always designed for, protect us from energy shocks and make sure we have a military response. But some have called it the strategic midterm reserve. So thankfully, elections are coming and they'll be over soon, and we can get back to hopefully normal life. But the strategic petroleum reserve is being dumped, and that's been one of the primary reasons oil prices are being lower right now. What's happened is since the Russia-Ukraine war, Europe is being plunged into a severe energy crisis right now. Europe has very little energy. They primarily get their energy from Russia and from the North Sea, but there's not much. And so what's happening is global energy flows have to be rerouted. This is the energy map today of the oil flows. And the only way Europe is going to make it through this winter is by massive rerouting of energy from Saudi Arabia, from Africa, and from the United States. But, a lot of people don't realize that the world's largest oil producer today is the United States. And this all changed from the 1970s and even the 1990s. The shale revolution has made America an energy superpower again. And so So Europe is in a deep crisis right now. They're going to have a very tough winter. A lot of their energy dependent industries are shutting down. They are going to have to be doing layoffs. It's going to put Germany and some of the big manufacturing powers in a recession no matter what happens. So we're going to see a pretty massive change in the energy market in the next couple of years. And oil flows. I don't expect energy prices to decrease. I expect them to remain elevated for at least the next decade. And energy prices will not revert to normal even if the Russian war ends, due to the lack of investment in global infrastructure, as I've already said, as well as the de-Russification of global energy demand. People are simply not going to want to buy Russian oil. And in fact, there's no way for Russia to get their oil to market. It's very difficult. China, there's not the pipelines between Russia and China. There's not pipelines between Russia and India. So it's very difficult. It's going to be very difficult to do that. And furthermore, the ESG initiative, which focuses on not just supply reduction, which I think is, demand reduction, which I think is great, but also on supply reduction, which is kind of nutty. Let's not stop, the development of fossil fuels until the green revolution is ready. And here's the kicker. This is what it's highlighted in yellow. Energy is the mother of all commodities. It's diesel fuel that powers the wheat combines. It's diesel fuel that powers mines everywhere across the world. It's trucks that transport goods and food and clothing and everything else. Energy is the mother of all commodities. And because every other commodity and every other item requires it. And so it ensures, if I'm right, and energy remains inflated for a period of time, we will have elevated inflation for you simply can't stop it. And it does. And the Fed, the only tool they have is this big tool called interest rate. Raising interest rates. It can't affect the lack of energy availability, and so the prospect is that they'll raise rates so high to start recession, and we will have still high inflation. And it's very similar if you were around in the 1970s. Actually was, and they called it stagflation. And I think it's definitely possible that we could end up there. What about the green revolution? So green revolution today, if you look at the center circle here, today the non-carbon energy amounts to 17% of global energy production. 83% is carbon. So as much headway as we've had, it's not enough. And that carbon is broken down here on the left into coal, natural gas, and oil pretty much evenly. In non-carbon, it's primarily hydro, nuclear, and wind. And it's really not that significant. So the green revolution is not ready for prime time yet. It's growing, but it's not ready. There's limitations. You look at, Europe, for instance, is trying to go solar, but it's at the same latitude as Canada. There's simply not enough sun. And so, these people need to do the math. And here's green's dirty little secret, is that green energy requires massive investment in dirty. Here is just a list of the minerals and resources needed for electric cars and for wind, solar, and nuclear. And you can see, copper, lithium, nickel, manganese, cobalt, graphite. It's enormous. Here's a little stat for you that's kind of, a little bit of a reality check. Last year, electric vehicles amounted to 4.4% of US passenger vehicle sales. 4.4, awesome. but they also used up 65% of global lithium mine production. Somebody see an issue there? I mean, wow, right? So where are we going to get the lithium? Well, good question. And so while the West went green and clean, the West went green and clean because the rest went dirty. And this is the big one here is Europe, the blue, the gray here is the US and North America. You see China and the developing world over here. They basically started producing all these dirty chemicals required. You can see here processing of battery minerals mostly done in China. And so here's the extraction of fossil fuels and these minerals. This is the Democratic Republic of Congo, Indonesia, China, Australia, pretty much a lot of third world countries. And over here, most of the processing is done in China. Almost all the processing for these things is done in China. So it's and it all requires fossil fuels to do this processing. According to, this is from the EIA, the Energy Information Administration. Check this out. Here's some of those same items. Lithium, in order to meet the Paris Accord stated goals, we need 12 times the amount of lithium production currently today, not 12% more, 1,200% more. And to make a sustainable development scenario, we need 42 times as much lithium production, 42 times. Same with graphite, cobalt, nickel. So a green revolution requires a massive investment in natural resources and a lot of time, and by the way, a lot of fossil fuels. So the point I want to make here is that fossil fuels, we're not getting away from them, not in the near term. And the market has very anti-marketly allocated resources. So it creates an outsized opportunity to be an energy investor. I'm gonna skip this one. So energy remains a massive way to invest. This is a megatrend. The tides are coming in and all boats will float in the energy space. And it's actually a really good time now because of any potential recession impulse is actually going to keep prices down where the stuff is actually affordable to buy. So it's great. I love counter trend impulses because that's the time to buy. Third megatrend. Yes, you read this right. De-globalization. Suddenly in 2020, supply chains had to be de-risked, right? 2020, all of a sudden people figure out they need supply chains. Now, after Russia invades Ukraine, we need supply security. And so now everybody is scrambling to figure out how to source and how to source without risk. And it's a massive issue, and it's basically a de-globalization impulse. We've had about 30 years of massive globalization ever since China entered the World Trade Organization in 1990 and brought, 1 billion workers, cheap workers and cheap labor onto the planet. The world has been chasing that. It's produced massive deflationary impulses. Cost of goods comes down, manufacturing comes down, and everybody gets happy about globalization. But we forgot to do is measure the risk of that. And we in our globalization impulse, the world went too far. Just to give you a picture, here's Russia, Belarus, and Ukraine are the #1 exporters of natural gas, uranium, neon, nickel, iron, wheat, fertilizer, and potash. Okay, just as an example, you get the picture. And so supply chains are going to need to be massively de-risked. Here's another shocker. China has seen its greatest days as a manufacturing titan. This chart shows the average wage of developing countries, the manufacturing countries. So China back in 2000, this is the red line is China. let me see, the green line here is Mexico. These are the wages. So the Chinese wage has had a 15-fold increase since 1999. China is no longer cheaper to manufacture than anywhere else. In fact, China right now, China is the #1 purchaser of robotics for manufacturing. They don't have a cheap wage. They have a lot of infrastructure built. But now people are saying, do I really want to do this? 15-fold increase, fastest labor appreciation in human history. They're no longer a cheap market. So here's another shocker that people don't realize. I say the sun is setting in the east. This is the working age population of China. The working age population are the people aged 15 to 64. These are the age of people who work. And working age population matters because population is linked inextricably to GDP. If I started my own firm or my own country, this is Bob Frazier, country, the GDP would be very low because it's only what I earn, right? And if I brought in another person, my partner, well, now I just doubled our GDP because it's the goods produced for the nation. Well, if your working age population is dropping, your GDP is dropping unless you're enhancing that by productivity per person. But here's what's happened. China's GDP working age population peaked in 2015. Their working age population is declining. And so you can see by what is it here, 2060, so 40 years from now, 55% of their population is working, only 55. The rest are retired. It's a gray tsunami hitting China. And by the way, if only 55% of your population is working and your working age population is declining, what's happening to wages? It's going up. There's fewer workers. China is in deep trouble. This is the population by age tranche. So each one of these bars is the people born in that year. So the people born in 1965, the people born in 1975. And you can see what's happening. They have this the younger people are, they're simply not, there's not as many. And what's happening, look over here, this is females on the left. There's far fewer females. And in fact, so the yellow is official numbers. The red is what most analysts believe are the real numbers. So they overstate their population. But either way, there's not enough females, and you're seeing a massive decline in population. So China is in deep trouble as a nation. And there's another reason why they're going to be in decline. So, Ray Dalio is wrong. The future is not in China, and we're not going to be learning Mandarin. In fact, the future is much closer to home. And I'll hit a couple more charts, and you'll see why I think so. Megatrend number 4, and then I got 2 more, and then these are quicker ones, and then I'll open it up to some questions and fun discussion if you guys like. Industrial boom, stage 2. The e-commerce building boom is over. The reshoring and inventorying trend is just beginning. So I want to show you this chart. So this shows you the growth, this percentage of retail sales by e-commerce retailers. So you can see it just steadily taking up as people shop online. And then what happened? Here's COVID hits. April 20, and boom. E-commerce, e-commerce just takes off. But then what's happening? Look at this. It's flattening out. I believe that e-commerce is not dead, but the growth rate of e-commerce is going to plateau. It's going to plateau. And so what's happening is now companies are wanting to build manufacturing and warehousing in America. And the reason is why? Everything I've said before. okay? The de-globalization, people want manufacturing in the United States. And you saw the Congress just passed the law to bring chip manufacturing back to America, but it's been going on way before that. You know, if you're Ford Motor Company and you can't ship a car because you lack a $4 chip, would you be willing to pay $6 for that chip to be manufactured in America? I think so, right? And so that's what's happening, and people are desperate for inventory and manufacturing in the United States. So it's massively, it's just beginning. This trend, we've had 30 years of globalization happening, 30 years. We've got 30 years, or at least 20, of deglobalization, where you see countries beginning to manufacture, especially big industrial powers like America, reshoring and reinventorying on their own terms, because we went too far in the previous trend. All right, I'm going to show that. I'm not going to skip this, just shows real estate values, but industrial demand. This is mind blowing. Here, this is from Marcus Millichap. And it shows these little dark bars are the number of million of square feet of new industrial space that have been brought online. So here about 300 million and 300 million new square feet built, and the net absorption. Look at this. Look at these numbers. The net absorption is just insane. And this line is the vacancy rate. Today, the vacancy rate is 2.9% in industrial. So what happens when you bring on 300 billion square feet of new industrial space? The vacancy rate drops. It just shows you how much demand there is. And it's going to continue. And, you know, so here's from Moody's Analytics. Warehouse distribution, you can see here the vacancy rate dropping. And here is the effective rent growth rate. The blue bars are the rent growth. So rent growth is going up, vacancy rate is going down. There's simply not enough. In spite of the massive building boom, it's not enough. Prologis has 5,800 customers, industrial customers. They're saying to meet just stated demand, another 800 million square feet is needed. This is from the Wall Street Journal. Number of reshoring jobs expected to be brought home in 22. You can see it just booming. So jobs are coming back. Manufacturing is coming back. Here's a kicker. This was just a couple days ago. Wall Street Journal. This is what I've been saying for the last 9 months was going to happen. And they said shift to high natural gas prices is pushing European manufacturers to the U.S. And so the U.S. is a energy superpower. We are actually the Saudi Arabia of coal and the Saudi Arabia of natural gas. And we are unique amongst all the countries in the earth in that our energy availability is right next door to our industrial capacity. What? You know, China has no oil. They have coal, but they have no oil, and they have no natural gas. They have all that. Literally has to be all brought in. Japan, same thing. Europe, same thing. They don't have it. America is the only country that has industrial capacity co-located with energy capacity. And so what's happening, so right now, for example, natural gas prices in Europe are about 5 times higher than they are in the United States. Natural gas, they're still flaring it in some places. It's too cheap. They just throw it away. So hopefully that'll end. But what's happening is now it's made America, forget the other reasons, reshoring and re-inventorying, now add the third driver of U.S. industrial demand is energy infrastructure. We have energy, we have abundant energy, we have cheap energy, and we have secure energy. You know, it doesn't require a tanker crossing, you know, the Persian Gulf somewhere to get here. It's all right next door, you know. So we have this is just the funnest time to be an investor in in this. So this is my number one market, I think, for real estate and it gets a perfect time right now with a potential recession looming to back up the truck with hopefully getting good prices on this stuff and capturing this trend. So we're super pumped about this area, and we're actively looking for great industrial investments and the great industrial strategies and best ways to play it. And we're hot on the tail of some of these, and hope to put some of these deals together in the short term. So this is kind of a fun chart. This is a chart of historical manufacturing jobs. All of a sudden, it's stopped going negative and it started going up. Manufacturing jobs are coming back to America. This is a statement from reshorenow.org. Some of the reasons companies are reshoring: social, ethical concerns, Walmart, $350 billion built in America campaign, inventory, energy, there it is, freight cost. So here's Moody's cap rate forecast, which I'm not gonna hit, but basically, we're gonna see great demand continuing for these things. The final trend I'm going to talk about is the housing shortage. Yes, housing shortage. 15 years of underbuilding, and we're still not out of it. We're still not out of it. So the recession is going to slow down demand a little bit. If there is one, looks like, they're going to keep raising rates until they get one. But it's not enough. So again, good time. I love finding these mega trends and then wait until there's a trend, there's a short-term blip that goes against the trend. That's the time to buy. Oops. So this is actually the number of housing starts relative to the population. And what I want to show is, these recessions, you can see them here, but this data goes back to 1960. And I want to show that this is the Great Recession over here. We have not rebuilt. We have not recovered, and there has not been a building boom in privately owned housing units. And so we're still underbuilt. We're still underbuilt. This is one of my favorite charts from Marcus Millichap. I love this. People have to live somewhere. Profound thought, right? They have to live somewhere, and either they will rent or they will buy. And if buying is cheaper, paying a mortgage rate, they'll do that. And if not, they'll pay rent and they'll do that. It's one or the other. And so what happens, you see this kind of rubber band effect. So this is a home payment. You can see in 2006, home payments got way ahead of rents, which is the brown line. And so they come down. And so there's this rubber band effect. If ever one gets too high, it comes back down, but pulls the other up and towards it. So they compete for a home, for a person living there. They compete either buying or renting. And so right now we're seeing, prices of homes having spiked, but what it's done, it's pulled up rents. And so one way or another, people have to live, and they're either going to rent or they're going to buy. And either way, I want to be in both spaces, to be honest. I want to be in both spaces. All right. And last chart, and then we'll take some questions if there's any time left. Well, we've been on about an hour, so maybe not, but whatever you guys want. Housing affordability. There's a thought about, that housing is too expensive, but I just did a little research. This is the percentage of the income spent on housing in various cities. And here's New York and San Francisco to the right. Having traveled quite a bit, I found that U.S. real estate is not expensive relative to other cities. So, and I think that's the future, right? We're going to see housing get more expensive because it just is going to. The cost, the inputs are just more expensive, and we're going to see density increase across the globe. So, All right, there you have it. I hope that was interesting. And I don't know if we have time, but let's take some questions if we do.
Yeah, if anybody has any questions, go ahead and take yourself off mute or throw them in the chat. We're right at about an hour, so we'll go another 5 or 10 minutes if we have a couple questions. And Steve's got a couple more announcements. And Steve, in the meantime, you want to throw the link up to the chat? Or sorry, networking. Great job, Bob. But
yeah, I'll throw the link for the wonder.me, and we can see you guys at networking after the Q&A, but I'll leave it up here until we close out. But yeah, go ahead. If anyone has any questions, go ahead and do that. Oh, and I did want to make one more announcement that I forgot. On October 6th, we have a Rise 48 deal webinar. The last one was very successful in terms of our community investing enough money to get to the higher tier. So if you want to be involved in another Rise 48 deal, try to make that webinar on October 6th, and we'll give you the details on that later.
all right. Bob, thanks again for the presentation. Very good, very insightful. I know as investors, we always want to skate to where the puck is going. So
There you go.
This gives us a good heads up and glimpse into where we're headed. I've got a couple questions, but we want to open it up here. We've got one. As a turnkey provider in the U.S., what data can I use to show investors why now is still a good time to buy U.S. real estate, even with rising interest rates?
Yeah, I think you got to show demand, and it, I mean, we're slow right now to buy. We're waiting in the single family space. We're waiting. We'll probably give it 6 months or so. But you can see our presentations. There's a huge shortage, and it's very different than the Great Recession. We're seeing very conservative bank underwriting. We're not seeing a lot of speculation in the markets. We're seeing household formation and real demand that's not speculative demand. So there's a lot of things that are very, very different than the Great Recession. So this is very different. At the same time, it's going to cause softness in the market in the short term. So I'd show them the fundamentals and give people a long-term view. But that said, there's always going to be opportunity because people are afraid, and that creates opportunity for those that aren't.
Thank you. I missed one here that came in a little earlier. What industrial industry have you been researching and investing in currently?
Well, we're primarily looking at industrial real estate, large, big box real estate. And so, 500,000 square feet-ish that can be used for transportation, inventory, or manufacturing. And we're very, very bullish. Even though there's been a building boom, there's simply not enough. And there's a massive, massive need. So we're going to be looking at value add plays in the industrial space. Already have a line on a bunch of this kind of stuff. And we're doing a ground up build ourselves, which we'll be announcing here shortly, and hope to do a lot more of that. So primarily big box industrial. If you want to buy a sausage, you can go buy PLD.
All right. We'll open it up for another round of questions through the chat or come off mute. While we're waiting for the next question to come in, Bob, a lot of the stuff you talked about tonight is very inflationary going forward. Energy, de-globalization, a housing shortage. I mean, the industrial boom round two. The Fed is currently doing everything they can to fight inflation, but a lot of that stuff is still very inflationary going forward. How do you see that tug of war playing out?
Yeah, it's the Fed has a they have one giant hammer. It's like a doctor who only has an amputation saw, right? That's the only tool he's got, right? And so that's what they're going to do. They're going to start cutting limbs off, so to speak. And the issue is the only thing it's going to do is affect broad-based demand. And if they would put as much energy into energy development and other things, they could bring inflation down. But they're not looking at the underlying causes, and that's not the Fed's mandate. I can't blame them. It's really the failure of our policymakers. What's new about that? But yeah, this is going to probably end in stagflation, and where we'll see a painfully stubborn inflation, not as high as it is now. It's going to come down, but it's going to continue, and that is going to be a moneymaker for investors, real estate investors. And I don't think they're going to be able to raise rates, to 6, 7, 8%. Where they actually create positive real interest rates. And so it's going to be bullish for real estate again.
Yeah, I had a question.
Go ahead.
Hey, Bob, it's Chris Odegaard. So I assume that when you put together these next opportunities, are these going to come in the form of new funds and the warehouse and distribution space and energy?
Right. Yeah, okay. Yeah, and yeah, do your tribe. Get your tribe. I know you guys. We're just partnering with these guys, and super pumped about that. And so we'll be making that available. We just did there was a question here. I see this. Where do you invest in energy? Again, I don't like sausages. I don't want to buy an energy sausage. I want to buy energy. So we went and bought a producing oil field that's a value add play in Western Kansas. The thing is a little money mint, and we're super pumped about it. And we're going to do more. We got a couple other deals in the works. And again, we're personally investors, so we're not trying to sell anybody anything, but we're finding really sweet deals. And with the energy price softening right now, just dropped below 80 today, super good. So now it's going to be great time we can get in at a better price for what we think is a really long play. But I want to own. I don't want to be in the public markets. I hate the public markets. I want to be in control. I want to know what I own, and I want to have a stock chart that just looks like this, not like this. So
I'm with you on that. Thanks.
And Bob, you alluded to the forming the tribes, and I think I mentioned that in the announcements, and I wasn't sure. But according to Travis, he talked to your group, and if you guys form a tribe through TribeVest and you invest in Aspen Funds, they will take care of the first year costs and services of up to, is it 1,000? Is that, Bob? Do you remember? That's what it sounded like on his email. I didn't want to.
I think that's right. So
okay, yeah. So $1,000 to cover your, operating agreement, your cost for state formation for the LLC. Your accounting fees for that year possibly, so up to $1,000, which is a great benefit. I think that would have covered my first year fees of my tribe that I formed with my family. So I would definitely take advantage of that. If and definitely call Bob and his team to ask more about Aspen Funds. All right. So, are there any more questions? Or Tom, go ahead, Brian.
Nope, I was just going to ask any more questions before we wrap up for networking on Wonder.me. All right. Yeah. Bob, again, very good presentation. We appreciate that. And for those of you that are going to the meeting in October, Bob will be out there speaking. And for those of you that aren't, if you enjoyed tonight's presentation, sign up for one of the last few spots we've got open for the meetup. And Bob, I might have you close out the recording here in just a minute, because I think you're host, unless you want to transfer that back to me.
Yeah, happy to do that, and I'll send you a copy of that. But yeah, great to be with you all today, and look forward to meeting you all in Ohio in person. So be fun.
All right, excellent. Thank you. And so I did put the network link for Wonder.me on there. And Bob, if you wanted to join it, you're more than welcome to. Sometimes some of the presenters have joined in and answered questions a little bit more in a smaller group setting. So you're more than welcome to do that. So once you click on that link, if guys have not been on that, you'll be sent to the Wonder site, and you'll have a little icon that you can actually move around with your cursor and just try to join a group with some other people, and then you'll all be able to talk in that little bubble. And if you get bored with someone, you can just go to another bubble, and no hard feelings. Just people want to network as much as they can. and the password is capital LFI 22. And we'll leave this link up for a few minutes because you have to actually close out your Zoom as well. So, but Ryan will keep this link up for a few more minutes. So hopefully we'll see you on this wonder.me networking site.
All right, thanks, guys.
All right.